Okay, so it's 12:30 now, so we'll get underway. So hi everyone, welcome to the Q2 2024 Carrington webinar. I'm Lucas and I'll be hosting the session today, and I'm also joined by Mo and Nitesh. So today we'll be discussing a few different topics. Firstly, what has happened in the markets over the last quarter, and then we'll also be using Nitesh's expertise in commodities to look into that, and then also looking into the portfolio performance over the last quarter, and then finally the outlook for the rest of 2024. So as a quick reminder, please feel free to post any questions into the chat, and then we can address them all at the end. So as I said, we're joined by Nitesh from WisdomTree. So Nitesh, would be great if you give us a quick introduction about yourself.
Yeah, sure. So I head up the commodities and macroeconomic research here in WisdomTree in Europe. And for those of you unfamiliar with WisdomTree, we're a global asset management company focused on exchange traded products. So globally, we manage about 110 billion of assets under management, and about 30 billion of that is managed out of Europe. And of that 30 billion in assets in Europe, about 20 of them are in commodities, commodity exchange traded products. So it's quite an exciting place to be in terms of looking at the commodity landscape. We get a good sort of vista in terms of flows in and out of commodity strategies to get an understanding of where people are optimistic or pessimistic in the commodity space. And we as WisdomTree like to provide a lot of research to our client base to be able to make sure clients are comfortable with the drivers of commodities, what drives their prices, why they belong in a portfolio, and what is driving supply and demand dynamics for those commodities as well. So it's a pleasure to be with you here today. Thank you.
Yeah, thank you for that, Nitesh. It's great to have you here. So we'll get straight stuck into it. So we'll start with the summary of Q2 2024. It's been a quarter that we've seen been dominated by large gains in the US, specifically the Magnificent Seven. And then also there's been a lot of anticipation of interest rate cuts. So Nitesh, it would be great if you give us like an overall macro view of what's happened and what you think the key points are from Q2.
Yeah, so I think from a global economic standpoint, it's another quarter of resilience by and large, especially coming from the US. So economic performance has been good. And that in turn has been another reason for the Federal Reserve in the US to postpone or prolong the period before its rate cuts. So its latest policy meetings really did indicate that it's willing to wait a bit longer. And if you look at so-called dot plots, they don't really have any real cuts until the sort of the latter part of this year. And there's been a constant fight between the Fed and the market. The market's always pushing for rate cuts to come earlier, and I think the Fed is looking to make those rate cuts, but doesn't have enough weakness in the economic data to be able to justify it yet. But we are seeing inflation in the US roll over, and that weakness is really starting to manifest. Now, with the inflation data from the US, maybe some parts of it are just slow to react to the reality of the world, including weaker shelter prices. And if you use more real-time data on shelter prices, we'll probably see that the inflation numbers there are actually probably at the point at which the Fed could be cutting yet. But once again, it's focused more on the PCE numbers. So it's in a bit more of a holding pattern. In terms of assets that have performed, it's largely been equities that have been sort of the outperformer across most of the big asset classes. So far this half of the first half of 2024. But commodities, the area that I mainly specialize in, is rising up the ranks. And if you look at commodities last year, they had a terrible year in 2023. And that's because rates were higher for longer. And China, which is the largest consumer of most commodities, was faltering. And it didn't seem that the policymakers there were really willing to provide a huge amount of stimulus. Come this year, we're getting closer to those rate cuts, and we've already seen rate cuts in in Europe with the ECB, Swiss National Bank, Riksbank, for example, already cutting. But with China, potentially around the middle of this month, we could see some more policy moves from China as well as they meet up for their plenary meeting. But so far, precious metals in the commodity space have done really well, up about 15% since the beginning of this year. Industrial metals also up close to 10% since the beginning of this year. And that seems to be a bit of a reversal of where it was last year, because a lot of people were expecting the energy transition scenario to sort of slow down last year. But when we get confirmed numbers of adoption rates of electric vehicles, especially in China, grid expenditure, renewable deployment, we've seen a lot of demand for those metals. So we've actually seen a fairly good period for industrial metals, correcting where we were from last year.
Thank you for that, Nitesh. That was really insightful. So I'll now hand over to Mo. So Mo, is there anything you'd like to add about that?
Yeah, good afternoon, everyone. Thank you very much for joining today. And please feel free to ask questions. This is the first time we've covered commodities specifically in one of our webinars. So Nitesh is obviously has vast expertise in this space, so please feel free to put the questions through. And so just to echo, some of Nitesh's points this quarter, I think from a sort of macro news flow point of view has been probably less eventful than some of the other quarters we've covered. But yeah, look, inflation data is coming down. Obviously, we saw a more normalized print in the UK. The European Central Bank have already started to cut interest rates, and it's widely expected that the Bank of England will follow. And as Nitesh mentioned, the markets are trying to pressure the Fed into the US Federal Reserve into cutting interest rates sooner rather than later. And very recently, probably in the last sort of 2 weeks, we've had a few data points that have come out that have been a bit soft for economic data, particularly around employment and some of the other sort of macro data in the US. And so that's sort of led to a slight move in markets, and that they're anticipating or increasing the probability that the Fed will cut earlier rather than later. And then just bringing it back to the actual portfolios themselves. So again, it has mentioned that equities were pretty strong through the quarter. The US did quite well. The UK did well also. The FTSE All-Share had a decent quarter. Markets in Asia, particularly Hong Kong, performed pretty well. So across the board, there were bright spots with regards to equities. And then outside of that, corporate bonds had a good quarter. Government bonds less so. We're still seeing lots of volatility around the government bonds, as they're the ones that are most sensitive to expectations of interest rate cuts, and therefore, because of this sort of battle, as Nitesh said, between markets and central banks, there's quite a bit of volatility in those particular holdings that we have. But whenever the interest rates come through, we expect those parts of the portfolios to begin working. And lastly, so we've had gold for a long time now. From Q1 2019, it had another good quarter. So that continues to work well for us.
Thank you, Mo. Yeah, so gold has had a very good kind of last quarter with all the central banks buying up a hefty amount of reserves. And then also we've seen oil hovering above $80 per barrel due to the geopolitical tensions, the likes of Ukraine and Russia, and then also the Middle East. So Nitesh, it'd be great to hear your thoughts on how you see these all-time highs within the commodity space continuing. Do you think they can stay at these levels, or do you see like a sell-off? It would be great to hear your thoughts on that.
Yeah, so let's start off with gold. It hit all-time highs in April and then even higher in May. But then in June, it gave back some of those gains and softened a little bit. And my expectation is maybe for the next quarter or so that gold could continue to soften before it starts to rally again. And the key catalyst for that next rally is interest rate cuts. Now, if we look at gold prices, what drives gold prices? gold is quite different to most commodities. Most commodities, you look at them and you say, what's the balance of physical supply, physical demand, any mismatch in the two? You know, if the demand is greater than the supply, you look at upward price pressure, and vice versa for downward pressure. But for gold, it's more like a pseudo currency, an FX asset, and it's really big macro moves that drive the price. Our models indicate that the key things for gold prices are bond yields, particularly US bond yields, the US dollar exchange rate, when looking at gold in dollar terms, inflation, and a sentiment factor. And that sentiment factor we measure through speculative positioning in the futures markets for gold. Now, the rate cuts that we expect later in this year, that should drive bond yields lower and should bring the dollar softer. Right now, the dollar is looking quite expensive just because the interest rates, differential between the US and other parts of the world are quite large, and that's giving that sort of appreciating pressure there. As that comes off, that should be all positive for gold prices. Now, you mentioned something very interesting earlier, that the central bank's buying of gold should have been price positive. And yes, at the margin, is probably good for gold prices rather than bad for gold prices. But in our modeling work, we've tested flows into central banks, jewelry buying, flows into exchange traded products for gold. And none of those things, once you condition for the four things that I mentioned, remain statistically significant, which indicates that they probably matter but on the margin. And if you look back at the April-May period, when gold prices were hitting all-time highs, the confirmed data from central banks actually showed they were softening their purchases of gold around that time, not actually ramping them up. You only find out the data after the fact, so but it is clear that a lot of the narrative that a lot of the market was providing for why gold prices hit all-time highs wasn't quite spot on. But our modeling work indicates that with all the other four variables, it was pretty much there. I think by May, it started looking a little bit ahead of fair value, and even in June, it was looking a bit toppy. So, but we are giving back some of those gains, and I do expect a bit of softening once again for next quarter before it rises. So that's gold. Other precious metals have rallied on gold's coattails, and if you look at silver, it's up almost twice as much as gold since the beginning of the year. So you got that close to 30% gain in silver prices since the beginning of this year, which is looking pretty strong. And in the oil markets, as you say, there's been a lot of movement, but within a relatively tight band. And the top of that band is around sort of 90, and the base of that band is around 75. Now, oil is one of the stranger commodities out there, in the sense that 45% plus of the supply of that commodity is controlled by one cartel, and that's called the Organization of Petroleum Exporting Countries, OPEC. And they have, for the last couple of years, been in a place of production restraint. So they're trying to reduce the amount that they produce to be able to keep the prices above a certain level. I mean, their stated mission is to keep markets in balance, but really what they're targeting is a price. And that price, we believe, is above $80 a barrel. On top of that, you have the US, which is now the largest producer of oil in the world. In previous years, it had drawn down its so-called strategic petroleum reserve. A large part of that petroleum reserve had been drawn down to push prices lower. But now that reserve is significantly below its capacity, the Biden administration has said that below $79 a barrel, it will start replenishing it. So it sets a nice floor for prices there. So you've got OPEC and the US government helping to support prices when it falls below a certain level. And at the cap, around 90 is about enough for OPEC, because it realizes the more it pushes oil prices higher, the more market share it gives away, and primarily to the US. So US, Guyana, and Brazil have been taking a lot of market share. So that's why it moves largely within that range. Now, that may sound like a very unexciting, investment prospect, something very range bound, but the way you invest in oil, well, most people invest in oil, is through the futures markets, or instruments that use the futures markets, like exchange traded products. Now, one of the interesting things about futures markets is that the shape of the futures curve matters for the investment almost as much as the spot price, and especially the case in oil. Because of OPEC's actions to tighten the market, they've put the curve into what is called a backwardation position. So the price of something for prompt delivery is a lot higher than, say, 1 month out or month after that. Now, the advantage of that is, as you invest somewhere further along in the curve, as time goes on, that the price of the contract, let's say several months out, as it approaches expiry, approaches spot, it's actually gaining in price, and that gives you a source of investment. And that yield on that so-called roll yield is close to 8%. So just if OPEC don't do anything but just keep the curve in the same position, and the price of the whole curve doesn't move around, you got 8% yield on oil, which is quite an attractive thing for investors.
Okay. Yeah, thank you, Nitesh. Just going back to when you mentioned the precious metals, there's been a lot of talk about how the AI transition requires a lot of these data centers, and copper is going to be quite a key precious metal within that. I want to get your views on how you see kind of like the demand and supply imbalances in the copper market, and what price that can have on the copper spot price.
Yeah, copper is a very interesting market. There's many support factors from the demand side. One, which I alluded to earlier on, is the so-called energy transition. So anything that requires the renewable technologies, whether they talk about solar panels, wind turbines, even at the downstream, the electric vehicles use a lot more copper than their internal combustion equivalents. That has been one big boon for copper demand. The other one is artificial intelligence, the data centers around it, even the 5G technologies. That's something that's really copper intensive, and all of these things will require massive improvements to grid infrastructure for all the economies hosting these technologies. So that means a lot of copper will be used for distribution and transmission cabling. At the same time, copper supply is looking quite tight. The big copper mining countries like Chile, Peru, Panama, they've all been suffering from supply pullbacks. The governments of those countries haven't been that supportive for the mining industry in recent years. And local communities in mining regions have been pushing back on mine expansion. Panama is a prime case. The Cobra mine there was shut last year, because of the government forced it to be shut because of social pressure. Even though you've had a change in government, it's unlikely that the mine will reopen anytime quickly. Changing the government is probably the easiest part of the formula. You also need to get the Supreme Court to overrule the closure decision, and you need popular support for it as well. All grades for copper are generally declining, so that means that miners have to dig deeper and harder and spend more money on mining to get less material out the ground. So we've been in a supply deficit for copper for the last 8 years running. When I mean say supply deficit, so the demand for the metal has been higher than the amount of refined material being produced, and we're likely to go back into another deficit this year again. Although we started the year with lots of supply surplus forecasts, I can easily see that rolling over. And you can see a lot of the smelters out there. So the copper refining community, especially out in China, they have been charging almost minimal treatment costs and sometimes even negative treatment costs. So the price that they charge to take the material off the miners and put them into finished goods are that low or even negative because there's such little of it out there. So they're competing that hard to get hold of it. Which has led a lot of them to actually shut their production, mothball it for a while until prices or availability of oil, of the material improves. So copper is one of the key beneficiaries, I think, of this energy transition, AI transition, and 5G transition.
Yeah, thank you, Nitesh. Yeah, it has been quite a key topic of conversation I keep reading about, so it is great to hear your thoughts. So as we can see, a lot has happened over the last 3 months. So Mo, it'd be great if you could give us an overview of how the portfolios at Carrington have performed regarding all these different news stories.
Yeah, absolutely. So thankfully, the majority of the portfolios, if not actually all portfolios, were positive over the quarter. Not as strong as Q1, but positive nonetheless. I think I've already got into the parts of the portfolios that perform. So appreciate that some of the higher people in the higher risk more portfolios will have less exposure to things like physical gold, but the equity parts, as I mentioned, have worked quite well. And then just sort of moving forward, so just trying to sort of put it all together, I suppose. Nitesh mentioned, that commodities had a bit of a tough time last year, bar gold. Gold actually was quite strong in 2023. We've looked at that as an opportunity to bring some into the portfolios in different ways. So we've been steadily building that up over the quarter. So many of you should start to see things in your portfolios with sort of commodity names attached. So copper is a good one where we're looking at ways to try and gain some exposure to copper, given the long-term positive story attached to that. And just having some more broad commodity exposure, I think, partly for the weakness that we've seen and buying into that, but secondly, also for diversification reasons. They can be quite helpful during different market conditions. And then gold as well. So gold we've continued to build up, and then for certain portfolios, more the sort of mid to higher risk portfolios, we've leaned into the companies that mine gold as well. So as a sort of amplified effect on the gold price, and there is a potential valuation opportunity there at the moment. They haven't quite kept up with the gold price. So I appreciate Nitesh might have a different view here, but we expect that at some point in the next sort of 6 to 12 months that gap can close, and we should see some outperformance coming from that particular holding. Outside of that, I think we're generally happy with our positioning. We maintain the largest equity allocation to the US, although we've been quite busy at trying to ensure that we're sufficiently diversified. So Lucas mentioned at the beginning about the Magnificent Seven. So they're the sort of big tech heavyweights in the States that have been performing exceptionally well for multiple years and were very strong last year, continue to be strong this year. Not all of them, but some of them, and particularly Nvidia, as I'm sure many of you read in the press. We've enjoyed those gains, and we've just felt that actually it might be time to just ease back from that. There's probably a bit too much optimism and over allocation to those particular names and sectors. And so when we see over sort of exuberance or extreme pessimism in markets, we do react to that. And in the case of the Magnificent Seven, we think it's probably too much optimism, so we've eased back a bit and just tried to ensure that there's sufficient diversification in the portfolios, so that if the day comes that for whatever reason they begin to give back some of those gains, and we're not sort of caught out in that. So yeah, that's, I think, in a nutshell, we're just sort of patiently waiting now for some of the things that we've brought in to come to fruition.
Okay, yeah, thank you, Mo. So we'll now move on to the outlook for the rest of the year. So at the start of this year, there was a lot of anticipation of rate cuts. So the market was originally pricing in 6 cuts. Now it's effectively pricing 1 cut for the calendar year. So it'd be great to hear from you, Nitesh. How do you see kind of the markets unfolding for the rest of 2024? Do you think they're going to be any key drivers? What do you think the general trend will be?
Yeah, so you're right. There's a lot anticipated at the beginning of the year, and that's been that's been moderated. And I think it's the the Fed primarily having won over the markets, right? The markets had a lot priced in, whereas the Fed's dot plots even at the beginning of this year looked like they were planning to do very little, and they followed through with that. Once again, they are data dependent, so should the data soften markedly, they will react to that. But it's been a story much more of economic resilience from the US as opposed to weakness. So I can't really see a massive turnaround of that in terms of the broader economy. But I think the pricing points are looking a little bit weaker, as I mentioned earlier. Shelter costs are probably falling a lot faster, and that could actually justify more deeper cuts. I think the rest of the world, we've seen, in Europe, we've seen the rate cuts from the Eurozone and a number of other European central banks, and I think that could continue, especially with, weakening pricing dynamics across the board. I guess there's going to be a little bit of interaction between pricing forces and political uncertainty as well. We're getting a lot of that in Europe. The French elections just over the weekend provide a little bit of a vista into that. That there is a lot of uncertainty out there that could lead to abrupt policy changes, which which could fall in either way, but more likely to be price positive in terms of increasing inflation as opposed to decreasing inflation, and potentially make the job of central banks a little bit harder. But one central bank out there that we're looking for some action is the People's Bank of China. The Chinese economy has been weak for a while. It's been dealing with a real estate implosion that it hasn't really dealt with properly. And one of the reasons why the central bank there has been hesitant to do much more is that it doesn't want to weaken the renminbi too much. And what it's waiting for is the Federal Reserve to make its move before it starts to cut interest rates in a more broad-based fashion. So there's a lot of dependency. So once the Fed starts cutting, then we could see a lot more loosening of policy around the world. And it's not something that's unique to the PBOC either. A lot of the other central banks are really kind of hoping for the US to move, because they're worried about currency movements by doing too much before the Fed. But once you start getting that in place, that's going to be very positive for all cyclical assets, commodities included. The stimulus activity and the lower rates are generally very good for commodities. And commodities are generally what we call a late cycle asset class. They tend to do well even when you're very deep into the economic cycle of a recovery and into even the first phases of a recession. Not that we're saying recession is on the cards, but even if you see a significant weakening of the economy, commodities tend to do quite well then, even though equities start to roll over. And commodities and equities, although they're both cyclical assets, their cycles aren't quite in sync. So commodities are quite nice to have in the portfolio in the latter phases of a of the economic cycle. So that's maybe something to think about in terms of positioning.
Thanks, Nitesh. So Mo, is there anything else you'd like to add on the 2024 outlook?
No, I think that maybe just one more point before we probably get onto Q&A given timing. So obviously geopolitics has been a big one for a while now, and I appreciate we've touched on it a little bit through the webinar. for the time being, that things in the Middle East seem to be calming down, or maybe just sort of less than news. But clearly, the US elections coming up in November, and Q3, therefore, we could potentially see a pickup in the rhetoric, or related to geopolitics, especially given that it looks like increasingly like Trump will come into office. So there could be lots of anti-China rhetoric going around, and that may create some more volatility, and the talk of tariffs, etc. So I think potentially we could geopolitics become go back up the rankings in terms of a talking point, and something that causes some volatility in markets, or certainly in particular markets. And so yeah, there'll be that, and then as Nitesh mentioned, this widely anticipated interest rate cuts from the US Federal Reserve. So I think they're going to be probably the two key points as we go into sort of Q3 and the back end of this year.
Maybe then I can add to that, the geopolitical concerns are probably an upside risk for gold. I talked about my forecast earlier on, maybe it's sliding a little bit for the next quarter before it starts to rally back toward new all-time highs around 2,580 by the middle of next year. But that's conditioned on a very sort of sanguine geopolitical environment. If these risks pick up, we could see gold prices accelerate, and I wouldn't rule out gold prices over $3,000 an ounce in certain scenarios where geopolitical risks really ramp up. We've seen it already this year, or last year when the Israel-Hamas war broke out, the year before when the Ukraine-Russia war broke out, but other geopolitical sensitive events are likely to be very gold price positive.
Okay, yeah, thank you. So we'll just discuss one more kind of general point, then we'll move on to the Q&A part of the session. So I'll start with Nitesh on this one. So what is one position you feel like you have a lot of conviction with and perform quite well in the second half of 2024?
Yeah, great question. So I think we've discussed it a little bit already, but copper is one of my favorite commodities at this point in time. Especially from the medium to longer term, prospects. There's huge amounts of new demand for the metal. At the moment, energy transition only accounts for about 20% of copper demand. But by 2030, that could be close to 30 to 50% of total copper demand, depending on which sort of climate scenario you look at. So that's going to be massively game-changing, and the miner community haven't really stepped up yet to actually produce the amount of material that we need. So from my perspective, when you invest in the metal through the futures route, the miners not so much, because once again, they're not really taking advantage of the current environment. They're not stepping up their volume of production. But if you invest through the futures route, or the exchange traded products on the futures, that looks like a very high conviction view, in my opinion. But there are other metals that also benefit from this same sort of framework. Tin, for example, even aluminium, which is very useful in sort of lightweighting metals. But if you're looking for a single commodity, I'd put my money on copper.
Okay, thank you. And Mo, is there any ideas you may have to add to that?
Well, I think maybe let's do something a bit different. I think, but also maybe related is we finally started to see some life from Chinese-related equities earlier this year after 3 years of underperformance, where I think sentiment became extremely pessimistic towards Chinese equities. So I think we've seen a very small recovery earlier this year, and some of the data appears to be mixed, but maybe improving, some green shoots. As Nitesh mentioned, we've got the plenum coming up, which could be influential in their policy-making decisions. And then clearly, once the Fed cuts, then we could see some cuts there. So I think actually, given that investor positioning is so low at the moment towards Chinese equities, I don't think it will take much for the markets to perform very well. And so I think I'll go with something slightly different and say that maybe the back end of this year into next year, Chinese equities might actually perform pretty well.
Okay, yeah, thank you, Mo. So we'll now kind of turn to the Q&A part of the session. So one question that's come through directed at Nitesh, I assume. So how do you see the energy transition playing a part in the commodities sector?
Yeah, I think energy transition can be quite transformative for commodities. And if you look at broad-based benchmarks in commodities, look at the Bloomberg Commodity Index or the S&P GRCI Index. If you look at what's the main components of them, it's traditional energy, right? I mean, obviously, the indices that are designed to be UCITS compatible, they have caps on various sectors. Beyond those caps, you see huge allocations to oil, natural gas, and metals have. I mean, they have close to a quarter of the index composition in those traditional indices, but they could be a lot larger if the constraints were taken off. So what we could see is that indices that are designed to look at future demand rather than looking at past demand, which those established indices are focused on, where the current weights are really driven by past economic relevance and liquidity of the contracts, futures contracts in those commodities. If we were to drive it to something that's more future looking, we could see the positioning of metals becoming that much more important than the hydrocarbons, because that's the metals are used for renewable sources of energy or even the downstream use cases like in electric vehicles or equipment they're designed to reduce carbon from the atmosphere. So energy transition, we think, is going to be a bit of a game changer for the shape of the commodity markets in the future. And we at WisdomTree have developed product ranges that can lean into that. So we look at, say, a metals basket that look at the role of individual metals in the energy transition, where you'd have, say, higher allocation to things like nickel and copper than you'd find in traditional benchmarks.
Okay, yeah, thank you, Nitesh. So I'm conscious of time, so I'll try to fit in two more questions. So I have this one from Mo. So how would you gain exposure to rare metals within the Carrington portfolio?
The rare earth metals?
Just, yeah, rare metals. So I assume it's like copper, silver, gold.
Okay, so well, there's two main ways. One of which, yeah, Nitesh has already mentioned that you can do it through various sort of ETF or index-like products. Clearly, there are lots and lots of choices in that market. From plain sort of very simple indices such as the Bloomberg Commodity Index, which is just a catch-all type product, to lots of other variations that Nitesh has mentioned, and then clearly you can then go for the companies that mine those specific metals, which Nitesh mentioned, he's sort of less keen on. But yeah, so there are sort of, I would say, just probably two main ways. They're very high level. Clearly, there's lots and lots of variations to those. There are some groups who have the flexibility to go between the physical commodity and or the equity. So that potentially is quite attractive, assuming that they can get those calls right and their timing is good. But yeah, in a nutshell, I think they're probably the two main ways.
Okay, yeah, thank you.
If I can maybe add to that, if you're looking at rare earths themselves, there's not that many direct commodities or futures that you can access them. So it is pretty much the equity route that you need to go through. But then there are, as you mentioned, indices that look at various companies involved in rare earths. So we have products that do that. But rare earths are a little bit down the scale in terms of availability of things in liquid futures markets, and therefore the equity route is really the main avenue.
Okay, yeah, and that brings us on nicely to the last question. So this would be for Nitesh, if you give it a good go. So there's a lot of topic about how gold is kind of reaching all-time highs and it's making a lot of return. So do you still see gold as a hedge against inflation?
Yes, absolutely. Gold has been a fantastic hedge against inflation for many decades. If you look to the late 70s, early 80s, it did its job fantastically well. It's easy to observe that. But even when we saw the elevated inflation in 2021, 2022, although gold prices didn't rise as much as the headline inflation numbers did, it was facing headwinds from higher bond yields and a strong dollar. When you put them all into the mix, it looks like gold is doing its job against inflation, but it's just being knocked back by other things. So looking at future inflation, if you don't get that coupled with rising bond yields and a stronger dollar, it will be able to do what it should be doing. But broad commodities, I would say, are possibly an even better hedge against inflation. And broad commodities include a little bit of gold, but a whole host of other things. And broad commodities are quite nice because they react to the so-called unexpected sources of inflation. And bonds are very good at dealing with expected inflation, right? So if you think about an overheating economy that would likely drive up inflation, that would be well reflected in bond prices. But the unexpected things like oil price shocks, food price shocks, all these sort of things get really well reflected in broad commodity indices. And possibly that's one of the best ways to hedge against this.
Okay. And Mo, is there anything you'd like to add that on your views while we still have a bit of time left?
No, I think yeah, Nitesh summed it up very nicely.
Okay, brilliant. So that's a wrap on our Q2 webinar. So thank you very much for everyone for joining. I hope you've enjoyed it and it's been insightful. And I guess we'll see you for the Q3 webinar in 3 months' time. So everyone have a good Monday afternoon. Thanks for joining.
Thank you all. Thank you very much for joining.
Thank you. Bye-bye.
Thanks, Nitesh. Bye-bye.